Welcome back to another edition of Market Brief After Hours. It's been quite the Thursday session. If you were looking for a calm day of trading, you definitely didn't get it. We saw stocks drifting lower, volatility creeping back in, and a very distinct shift in the mood. We're dealing with a mix of liquidity concerns in the financial plumbing and some serious geopolitical heat rising in the Middle East.
That's exactly right. It felt like the market was trying to spin plates today, and a few of them started to wobble. The risk appetite just wasn't there. Investors took a step back, particularly from the financial sector, and we saw a retreat into defensive positioning. It wasn't a panic, but it was definitely a hands-off kind of day.
Let's start with the big picture in the U.S. We saw red across the board. Give us the numbers.
It was a slide, but not a crash. The Dow Jones Industrial Average took the biggest hit in terms of points, sliding 268 points to close at 49,395. That's a decline of 0.54%. The S&P 500 fared slightly better, but still finished in the red, slipping 0.28% to close at 6,862. And the Nasdaq Composite, which has been under pressure recently, fell another 0.31% to end at 22,683.
So the S&P 500 is sitting right at 6,862. That feels dangerously close to flat for the year, doesn't it?
It is razor thin. After today, the S&P is holding on to a year-to-date gain of just 0.2%. We are essentially hovering at the break-even line for 2026. The momentum we saw earlier has really stalled out.
You mentioned the Dow was dragged down by financials. What is sparking this sudden concern in the banking and asset management space?
It's a liquidity story. We had news that a major asset manager moved to tighten investor access to private credit funds. When you hear tightening access in private credit, the market immediately gets flashbacks to liquidity crunches. It spooked investors. They sold off asset managers and financial institutions because they're worried about what's lurking in those private credit portfolios. It's the plumbing of the market that people worry about when rates are this high.
And on the Nasdaq side, it wasn't just interest rates. There is a specific narrative building around software stocks again.
Yes, and it's the double-edged sword of artificial intelligence. We had some executive commentary suggesting that AI is going to displace a significant chunk of existing enterprise software. So instead of AI being a boom for everyone, the market is realizing it might be an extinction event for legacy software companies. That pushed the Nasdaq down, extending its decline for the year to over 2%.
While stocks were struggling, oil was doing the exact opposite. We are seeing a serious spike there.
We are, and this is pure geopolitical risk premium being priced in. President Trump made a comment that he would decide within 10 days whether to launch military strikes against Iran. That kind of timeline, 10 days, puts markets on edge.
What did that do to the barrel price?
It sent it flying. U.S. crude settled up $1.54, or 2.36%, at $66.73 per barrel. Brent crude was up similarly, gaining over 2% to hit $71.88. WTI is now up more than 5% just this week, and nearly 16% for the year. Energy costs are rising, and that complicates the inflation picture for the Fed.
Speaking of the economic picture, we did get some data on the labor market today. Jobless claims dropped again.
They did. Initial jobless claims fell to 206,000. That is the lowest level of the year and well below expectations. It shows the labor market is still churning along. However, continuing claims ticked up slightly, which suggests that while people aren't getting fired in mass, hiring has slowed down. It's a steady, albeit cooling backdrop. Treasury yields didn't move much on the news, though. The 10-year yield is holding steady around 4.075%.
It seems like the bond market is in wait-and-see mode. Let's take a quick break. When we come back, we're going to look at the divergence between Europe and Asia, dive deep into the technicals on the Forex market, and break down some massive moves in individual stocks, including one company that surged 15%. Stay with us. Welcome back to Market Brief, After Hours. Before the break, we discussed the defensive tone in the U.S., but if we look across the Atlantic, the mood in Europe was arguably worse.
It was a tough session for Europe. The Stoxx 600 finished down 0.6%. If you look at the major country indices, it was a sea of red. Italy's FTSE MIB led the decline, dropping 1.22% to 45,794. Germany's DAX fell 0.93% to 25,044. The FTSE 100 in the UK was down 0.69% to 10,613, and the French CAC 40 slipped 0.36% to 8,399.
What was driving that pessimism in Europe? Was it just the spillover from the U.S.?
Partly, but they had their own corporate headaches. Airbus took a 7% hit. They guided to 870 commercial aircraft deliveries for 2026, which was below what analysts wanted to hear. And Renault fell about 3%. They reported a net loss of almost 11 billion euros, driven by a massive one-off charge related to Nissan. So earnings are weighing heavily there.
Now, if you want to find the bulls, apparently you have to look at Asia.
Absolutely. It was a completely different world overnight in Asia. The standout was South Korea. The Kospi surged more than 3% to close at a record high of 5,677. Samsung Electronics was up almost 5%. That is a massive move for a megacap.
And Australia held up well too?
Yes, the ASX 200 rose 0.88% to 9,086. Their unemployment rate held steady at a 7-month low. Japan's Nikkei also added about 0.5%. So we are seeing this uneven global landscape where Asia is rallying on tech optimism while the West is fretting over liquidity and geopolitics.
I want to get into the currencies now because we have some very specific technical levels coming into play. Let's start with the euro against the dollar.
Euro USD is in a really interesting spot. It edged lower to close at 1.1768. Now, for the technical traders listening, here is the setup. The pair is trading just a fraction below its 50-day simple moving average, which sits at 1.1769. It's literally right there.
So it's testing that short-term trend line.
Exactly. But it is holding comfortably above the longer-term support. The 100-day moving average is at 1.1688, and the 200-day is at 1.1644. As long as it stays above those levels, the broader uptrend from late 2025 is still intact. But if we break below 1.1688, that's when the alarm bells start ringing for a deeper correction.
What about the British pound? GBP USD has been struggling to hold on to its gains.
Sterling is under a bit more pressure. It closed at 1.3458, down about 0.25%. The key here is the 50-day moving average at 1.3525. The price is capped below that level, which reinforces the near-term selling pressure. It's currently sandwiching itself between the 100-day average at 1.3393 and that 50-day ceiling. It feels like the upside momentum is fading a bit here.
And looking at the yen, we've seen a bounce in USD JPY.
We did. USD JPY closed at 155.07. It found support right where you'd expect it to, near the 100-day moving average at 154.74. It bounced off that level perfectly. It's still below the 50-day average of 155.96, but as long as it stays above the rising 200-day average, which is way down at 150.60, the broader uptrend for the dollar against the yen is preserved.
Let's touch on the metals quickly. Gold and silver. Are they acting as a safe haven with all this Iran talk?
To an extent, yes. Gold settled at $5,001, up 0.5%. It's consolidating. The important technical note here is that gold is holding above all three major averages, the 50, 100, and 200-day. The 50-day is at $4,863, and buyers are defending that area aggressively.
And silver?
Silver had a very strong session, up 1.59% to $78.43. It staged a sharp recovery from the lows. However, unlike gold, silver is still trading below its 50-day moving average, which is at $80.19. That's the key resistance level to watch. If it breaks $80.19, the bulls are back in charge.
Let's wrap up with the market movers. We had some massive swings in individual names today. Let's start with the good news, Omnicom.
Huge day for Omnicom. Shares surged 15%. They beat on revenue, $5.5 billion for the quarter, up nearly 28% year over year. But the cherry on top was the buyback. The board authorized a $5 billion repurchase program. Wall Street loves a buyback, and the stock flew.
We also saw a big move in Etsy, which has been quiet for a while.
Up 9%. This was M&A news. They agreed to sell Depop, the fashion resale app, to eBay for $1.2 billion in cash. Investors liked that they are streamlining the portfolio. Plus, they beat on earnings per share.
But it wasn't all green arrows. We had a disaster in the rental car space, Avis.
Absolute carnage. Avis shares plunged 22%. The numbers were shocking. Adjusted EBITDA was just $5 million. The expectation was nearly $146 million. That is a massive miss. Revenue also came in light. It raises real questions about their operational efficiency right now.
And finally, Wayfair.
Wayfair slumped 13%.
It was the international sales that spooked investors. They missed estimates there, and even though the headline earnings beat, the growth story internationally looks shaky. In this market, if you show weakness in growth, you get punished.
It certainly feels like a market where earnings delivery is everything. If you miss, you get crushed. If you beat and buy back stock, you soar.
Exactly. The margin for error is zero right now. With geopolitics heating up and liquidity tightening, investors aren't in the mood to forgive bad results.
We will leave it there for today. Thank you for listening. If you find this useful, please follow Market Brief After Hours on your favorite podcast platform so you never miss an update. We'll catch you next time.